Good afternoon, everybody. My name is Emmanuel Akin Ola, market analyst at HFM Nigeria. Thank you for joining us in another interesting webinar today. How's everybody doing? I hope everybody is doing so well today. Thank you for always coming around when we have a session. It is important that we run a session like this today. This is one of the most important things that we deal with on a daily basis, especially with clients who don't understand so much about price action and how the market works in terms of movement. And one major thing that we try to do is to ensure that at HFM we continue to, do things that ensures your progress in this business and then your safety. If you look at the topic today, it says navigating market volatility, slippage, and gaps. Navigating market volatility, slippage, and gaps. It is important that we know about what market volatility is. It is key that we are tuned to the concept of price action because a lot of people don't know. I mean, price structure is one of the biggest things that quite a number of, clients or traders don't understand. So it's a little bit difficult for them to really understand the concept of market volatility and how it affects the business. I want you to, I just want to take you down memory lane a little bit. Let us find out some people who quite understand what I'm trying to talk about today really is. If you look at the screen, you'd see two lines moving side by side, right? You can see them moving side by side. You see, one thing I want you to understand in the first place is the definition of some of these concepts. Let us start with the concept of volatility. What do we understand by volatility? You see, speaking so many English about volatility might not do it. I need you to understand what we mean by volatility. You see, volatility is the reason why you can make profit, in two directions in the market. It's one of the main things that contributes to why you can, make profits in two directions. Think about it. A physical business, when you open up a shop or you open up a store that you want to start, selling something, you will need to go to a larger market to buy that thing, right? When you buy the product you intend to sell in your shop, you are incurring cost, which means you are the one paying, right? So you pay to get the goods and services. You then take it to your shop, hoping that people demands for it, and then you can sell it to them to make profit. Which means when you look at the process, you only make money on the selling part. You don't make money on the buying part. But now in the forex market, you have the ability to make money when prices are rising. You also have the ability to make money when prices are falling because the market has the ability, or prices has the ability now to rise and to fall. Volatility is simply the rise and fall of prices in the market. The only difference is that sometimes volatility could be high. The fluctuations in prices could eventually be high. And sometimes it could also be low when we have limited activities in the market. But volatility is really just the movement of prices up and down in the market, giving buyers and sellers the ability to make profits when prices are rising and when prices are falling. It is the reason why prices might not be able to move in a single direction for a long period of time. It also explains why you would not be able to see the market move on a straight line, because fluctuations must come in. Prices must always go up and down, irrespective of if a trend is going to be created or not. So volatility in of itself is simply the fluctuations that we see within prices in the market. What fluctuations are we talking about? The rise and fall of prices. Although sometimes it could be very high, and sometimes it could also be very low when liquidity reduces in the market. Now listen to this. If volatility is simply the fluctuations between prices, prices moving up and down in the market, and we also know now that volatility can either be high or low, depending on what the market is doing on a particular day. Oftentimes, the way it is, we do expect that volatility will most likely be lower and prices might be able to move in a particular direction over a period of time if there is higher liquidity in the market and lower external influences from maybe economic data or breaking news or news releases. But oftentimes, when liquidity also dies down in the market, where we don't find so much people, trading in the market, when we don't find so much activities going on, that could also cause volatility to go up as well in the market. So there could be, different factors that can contribute to heightened volatility in the market. We're talking about, economic releases. I'm talking about, central bank events. I'm talking about, economic data like CPI, like FOMC, like NFP, GDP, employment statistics. All those key events are capable of causing an increase in market volatility. Bank holidays, when there's holiday that also saps out liquidity in the market, that might also cause, an increase in volatility in the market. Now, but if you want to really understand the risk that comes with higher volatility in terms of slippages and gaps, which is two major things that comes with higher volatility in the market, you see, you need to understand price structure itself. A lot of people don't understand price structure. And I'm going to use that to teach you navigating slippages and gaps today. There are two main prices that you would always see in the market. Number one, you would always see the bid price and you would always see the ask price. You would find the bid price and you would also find the ask price. And this also relates to what you're seeing on this portion of the screen. This movement of prices that you're looking at on the board right here is also the movement of the ask and bid price in the market. The only problem is for most traders, you only have one showing on your screen, maybe because you've not activated the second one. Maybe you feel it's not important. It is very, very important. And this will help you get a very good picture of what I'm about to discuss today. Now, the bid price is simply the price that activates, sell orders in the market. And then we have the ask price that simply activates buy orders in the market. So we have the ask price activating sell orders. We have the bid price activating sell orders in the market. So basically, they don't serve the same purpose. So if you're looking at only one line showing on your screen, that one line is not the line you are using to buy. It cannot also be the same line you're using to sell. It's not possible. There are two prices for two different directions. If you're going to be taking a buy, it is only the ask price that can activate that buy. If you're also going to be taking a sell, it is only the bid price that can activate that sell. And when you're looking at this movement in the market, it is also what to note that naturally, the ask price would always be higher than the bid. Which means even if you don't know how to tell which is which, you should just always remember that the ask price would naturally always be higher than the bid price. Because the difference between them is what gives spread. So no matter how close it gets, there's always still going to be a difference because spread must be charged. So if you think about it, naturally you would always find the ask price higher than the bid price. So if you look at what we have on the screen, it means this particular line you're looking at here is the ask price, and this one lower is the bid price. So it means if I am going to take a buy right now, it means my buy will be activated at this line or this price. If I'm going to be taking a sell, it will be activated on this line. But another thing you must also understand is that when you look at candlestick and their formations, you see candlesticks forms with the bid price. Which means if you're looking at a chart and you can only see a line, that line you're seeing would always be coinciding with a candlestick. That line is always the bid. It is the bid price that follows candlestick. It is the one that moves or that forms when candles are forming or that follows when candles are also moving in the market. So it means if I decide to remove, for example, the ask price, saying I don't want to see the ask price, it means I'm only seeing one line. This one line you're looking at that is moving with the candlestick in the market is the bid price. It means don't get carried away thinking that one line is what we use for buying and for selling. Just because you're not seeing the second line is because probably you did not activate it, or maybe because they are very close to one another, like you can find on Euro USD. But if you activate that, you also want to see, the ask price, it would always show to show that, oh, listen, there are two different prices in the market, the ask, the bid, the one that activates a buy, the one that activates a sell. Now, why am I doing this? Because it is important for you to understand this. One thing that comes with higher volatility is there would always be a significant difference in the ask and the bid price, which means there is something that can potentially cause, a widened gap between the ask and the bid price in the market. There's something that can potentially relate to a widened gap in your spread. Naturally, when volatility increases, it causes that to happen. But a more structured language that we call that is slippage. You see, price slippage is one of the most important things that every trader must recognize when it comes to trading the global financial market. And I want to say this for you to understand. Slippage is a situation where price could not execute your order at the price to which you've requested it. Let me break that down for you. So now, you know now that the ask price would activate your buy trades. The bid price will activate your sell trades. Now you are looking for an opportunity where you can, maybe take a buy in the market, but then volatility is so high. You see, one thing volatility can do is it could cause a significant gap between the ask and the bid price, such that two close price lines might go far away from one another. So imagine maybe you wanted to enter into a particular trade, maybe on the release of like FOMC or NFP, and maybe as at the time to which you saw that particular market, it was at maybe 169 point, let's say 900, and then you take a buy. There is the possibility that market is unable to fill your order at that price because of increased volatility, causing a significant difference between the ask and the bid price. Remember, for a buy trade to be executed, it can only be done with the ask price. It means there's possibility that the ask price has gone far away from where the bid price is by the time the market is able to execute that buy trade. So it is possible that you saw, price at this level at that time when you wanted to enter into your trade, and eventually you were entered somewhere around here. It is no other than the fact that slippage has occurred, which means a situation where the market could not execute your order at the price you have requested it, but at the next available price. Now, listen, the next available price is also not an abstract price. It is also the price to which the ask price has gotten to. So it is not like maybe the market just sits somewhere and says, let us just help this person to execute it in one random number. No, it is never executed in a random number. It is the number to which the ask price is able to, pick up your order that it will execute that trade. So when we say, oh, I experienced a slippage, it simply means a situation where price is not able to execute an order at your requested price. Now, slippages could affect a number of things, even away from market execution trades. It also occurs in situations that relates to pending orders. Now, especially pending orders. You see, this one is even special to me. Let me also say this. It relates to the ask and the bid price. Please stay with me. Stay with me. Don't forget that we've just mentioned that please give me a minute, guys. Hello. Hello, sir. Yes. Now, you see, let us make something clear. We now know that ask will execute a buy trade, right? Bid will execute a sell trade. But let me also tell you something that you don't know today. This is for entry. On the entry side, please listen to me. I beg you. You might be able to teach someone this later. This is to execute or to enter. This is for entry. Now, if you want to exit a trade, if you're going to be exiting a trade, if you're going to exit a buy trade is going to be executed with a bid price. I'll explain it to you. Just give me a minute. And then a sell trade needs to be executed with the ask price. For those who use MT5, you must have seen something like this before. If you go under order history on MT5, you must have seen something like buy in, sell out before. Those who have seen it before would have seen it on order history or thereabout on MT5. The same trade, you see a buy in and sell out. Although the buy in will not have a value, but the sell out will have a value. Listen to this. It is because when you enter into a trade, a buy, saying that prices should rise through, an ask price, when you press close in the market, what the broker does or what the market does is to sell the position. It means an opposite direction is what closes your trade. The only reason why you don't have to press a sell when you have entered into a buy trade to close it is because sell is another direction. So it means the only reason why it is, listen to this, the only reason why it is buy and then close and then sell and then close is because we cannot say it should become buy, you then sell to close it, or sell, you then buy to close it. This will be very confusing. So we don't need you to, worry about if I buy now, it means I need to press sell to close. Don't worry. For the broker now, if you press a buy, all you need to do is press close. We know that close means to, take the opposite side of the transaction to close it. So if I take a buy, I know that by closing means I'm selling it off. If I take a sell, I also know that by closing means I'm buying it back. So you would always see like that on your MT5. Now, what I'm trying to tell you now is this. It means when you also put up like a stop loss or like a take profit on your trade, there's possibility that you are looking at, oh, my candlestick is touching my, my take profit or stop loss and it's not closing. It is because the appropriate price has not gotten there. Listen to me. It means there could be situations where you are looking at a candlestick like this. Touching your stop loss or your take profit, or even touching any of your pending orders. And yes, it is not getting executed. And you're asking yourself why. It is because the appropriate price needs to be the one to touch, not just any random price. It means for a sell trade to be closed, it is ask price that must touch that your line. And for a buy trade to be closed, it is the bid price that must touch that your exit line. Now listen to this. You see, that movement is also affected by slippage during periods of high volatility. What am I trying to say? In a situation where you have set up a stop loss, let's say, let me give an example. We set up a stop loss somewhere around here. Let's use current price movement. Now, if you look at this price movement, look at this. So let's say I have a stop loss that I set somewhere around here, maybe because I am selling this trade. So I put a stop loss somewhere up here, for example. Just as an example, I put a stop loss here. Listen to me. You can see that price is already approaching, right? Now, for this stop loss to hit, because it's a sell trade, asking price to go down, it means it is the ask price that will touch. And lucky for you, the ask price is the one above. So it means if ask price touches that line, the trade close, even without the candlestick getting there. That's another thing. The candlestick does not need to get there for it to close. Because what follows candlestick is the bid price. The ask price is always above. So there's possibility that the ask price has touched the stop loss even without the candlestick getting there. That happens. What I want to explain is this. So you are inside a trade, price is approaching your stop loss in this manner, and then suddenly a news hits the market. Maybe you were unaware of that particular news, but suddenly out of nowhere, the news hits the market, or a breaking news out of nowhere hits the market. What happens is, because of the kind of, fluctuations that is happening at that time, a lot of people are looking to close their trades. A lot of people are looking to open new trades. It causes a jump in, or what we call a significant difference between the ask and the bid price. What that means is there's possibility that as at that time, the ask price can jump above your requested price. only to take you out at the next available price. It means the stop loss will still work, but because the ask price has now significantly jumped above your stop loss, it would have to close you out at the next available price. It works the same way for also take profit, but there's also possibility of the market jumping if it is take profit too. If a news hits when price is about to hit your stop loss and it causes a significant difference between the bid and the ask price, price also will not be able to take you out at that take profit, but at the next available price. You must understand that it is price structure that explains all of this. It works the same way with your pending orders. If you set up a pending order and price activates you at a level that you did not request for, it is usually because when the price that needs to activate that pending order, either bid or ask price, got there, the market has significantly moved beyond that point. So it means the market can no longer fill your order at your requested price, but at the next available price. Don't forget what I explained. I said slippage is simply a situation where the market cannot execute your trade at your own requested price, but at the next available price. Usually when there is higher volatility in the market, either from news or a breaking event or a breaking news or a data release or whatnot. Another risk that could also come up with risk events includes what we call gaps. Gaps. Especially those who trade BTC on the platform, you would always notice gaps usually at the opening of the week, majorly. Also, other assets like oil might also have gaps, stocks as well. But let me show you what I mean by gap. All right, something like this. This is a gap. Because this is the place the last candle closed because it was selling. It closed here and then opened at this point. This is what we call a gap. Usually, this one can be explained by the fact that, CFD BTC will close on Friday, but the original BTC itself does not close on Friday. It means if you're trading real BTC, maybe on applications like Binance, you know that cryptos don't close for weekends. But because in a CFD market, in a Forex market, where all you're doing is speculating on the rise and fall of financial prices, we close for the weekend. So naturally, whatever activities are taking place on Saturday, Sunday is always reflected in a gap at the open on Monday morning. So this is what we call like a gap. For example, this is a gap. Let's see if I can find another one on asset that is not even BTC. I think I saw one on US oil recently. Let's go and check. So now I think I saw one on US oil recently. Yes, look at this one. Now this is also one on US oil. Look at it here. Well, this one is not even for the weekend. This one is simply, you know, the close of the day to the opening of the next day. So this was a gap. This is a gap here. A situation where the market opens at a different level entirely from where the last candle closed. Maybe because of higher volatility, as at that point also. So the market could not record, the transactions or the price movement at that point. So it just opens at The next possible point, we call that a gap in trading. It's also a risk. It's a risk when volatility gets so high in the market. It's a big risk as well. Because also this could cause a jump also in the ask and the bid price. Don't forget, like I told you, look at the ask and bid price again. So this could also affect the ask and the bid price as well. In fact, it's the major thing is going to be affected. And that means there's possibility of the ask price and the bid price jumping any of your stop levels, maybe your stop loss or your take profit or even your pending orders, and activating them at a different level. Because as at that time, the bid price and the ask price cannot fill your order at that requested level anymore. These are major risks that comes up with higher volatility in the market. What are some of the things that contributes majorly to things like this? Number one, big fundamental events. Really serious fundamental events. Which is why you have the economic calendar. In this case, the Forex Factory is available. The HFM economic calendar is also available for you. It means you can always be aware of high impact events that can potentially affect the market. You can be aware of, oh, this is an event scheduled for today. This is causing, this could affect, the market today. I mean, for example, we saw what happened with FOMC on Wednesday. It was instant impact in the market. We saw a crazy pump in price to the top, and almost the next hour, we saw again another immediate drop in market prices. For one, gold immediately, pushed into 2,600, and almost immediately after that 30 minutes, it crashed again. A single candle crashing to as much as 2,550. So events like that are some of the things that causes increased or higher volatility in the market. They are too important. NFP, CPI, FOMC, Bank of England, any central bank meeting are always so important because they can cause that initial jump in market reactions. Sentiment as well could be a factor that can cause increase in volatility, especially from the geopolitical side. Take, for example, you're just on your own trading, and out of nowhere, a news hits the market that some explosions were recorded in, let's say, Israel or Lebanon, killing some certain people. That's a breaking news that the market was not expecting. So that can immediately cause an increase in market reaction. Volatility picks up because a lot of people will be looking to come into the market. A lot of people would also be looking to exit the market at the same time. When that happens, that causes heightened volatility. It is important, ladies and gentlemen, that we understand some of the factors that can cause these things to happen. Which is why the first tip that you need to manage, and to navigate through market risk and volatility is to be aware of the current conditions of the market and also factors that can potentially cause a change in market activities. What does that mean? It means for me to navigate against something, it means I must know what it is. And that's why we have this training for you. For you to navigate against something, you can't navigate against it except you know what it is exactly and the factors that can affect it. So when we talk about slippages, we're talking about gaps, market volatility, situations where the market cannot fill your orders at your requested price, but at the next available prices. There are certain factors that causes it to change or to happen. Central bank events, very important. Economic data, very important. Breaking news, geopolitical events, very important. These factors would always cause a reaction in the market. I've created some other ones for you that could also help you, in navigating through market risks in the market. And one of them also is you should also choose, active market hours to trade. It means there are some periods that we also know, like naturally, to be highly volatile. For example, the Asian session, the midnight, it's not a period per se where the market is very liquid, and that means lower liquidity would cause, higher volatility in the market. Now, the Asian market is a market that we know that is characterized by, higher volatility in terms of also higher spread, because market is not that liquid in that period. For those who have seen it before, you know that if market wants to open, for example, the close of, American session to the opening of the Asian session, you would always see a very significant difference jump between the ask and the bid price. It means if you're really interested in protecting yourself against market volatility, like slippages, gaps, it means you must understand that there are some periods where those things are naturally evident, like the Asian market. We have sessions with higher liquidity that reduces the risk of such. The European session, the American session. The European session from 8 to 5, the American session from 1 to 10 p.m. in the evening. Those sessions have higher liquidity. We have a lot of people trading within that environment. And as such, it reduces the risk of, volatility coming out of nowhere. So you have to choose active market hours to trade. You have to trade during, highly liquid periods. You need to also avoid trading news events. I've already explained this because news events will majorly cause volatility and widening spread. What it means to say that widening spread is to create a significant space or gap between your ask and the bid price, which is the major thing about volatility. When news events hits the market, it's always a significant jump between the ask and the bid price. And that means you must be careful about trading news events. News events are not for everyone. It is especially made for those who are, who have deep pockets and who has the ability to withstand the level of risk that it comes with. One of these days, we have a recording for you or a webinar for you where we are going to discuss what it means to trade risk events. It is to come. We're going to explain to you the major steps, ways of approaching news event. But for now, to avoid, volatility in the market, having the best of you, you might decide to take a step away from trading news events if you don't have experience with it. Because naturally, news events would always ensure higher volatility when they're important, like central bank monetary policies like NFP, like CPI, like all of these factors, so important. You must avoid them if you're still starting your trading journey. Even if you're a professional, you must also learn how to navigate it and how to trade news events. That is to come. Please don't miss it. We're bringing that to you soon. You also need to use a reliable broker. Yes. You need to use a broker who will not protect his own interest, but your interest. And one thing about HFM that is not hidden is HFM is an STP broker, a straight through processing broker that ensures that we keep, your orders routed immediately to liquidity providers in such a way that your orders are not settled in now. So the broker has no reason or no avenue to even, trade against you or engage in practices that make the market go significantly higher than what it should against you. You must pick a reliable broker like HFM that ensures fair practices and good execution quality. HFM has taken on multiple regulations to ensure that our activities are in line with the best practices in the global financial market. We have multiple regulations around the world. We have regulations in Cyprus by the Cyprus Security Exchange Commission. We have regulation in the United Kingdom by the Financial Conduct Authority, in Kenya by the Capital Market Authority, in Dubai, in Seychelles. We have in multiple countries around the world. So we've ensured that the activities of the broker is always aligned with fair practices, and you can be rest assured that even if volatility is going to eat you in the market, it won't eat you beyond what the market is asking for. I can assure you of that. You need to also monitor and adjust trade sizes. What does this mean? It means if you're trading risk events, that is not the time for you to be increasing your lot size to the highest in the world. If you understand that it's a risk event, you're trying to set up a stop loss or a take profit, or you're even trying to set up a pending order like a buy limit, a sell limit, that is not the time to risk everything in the world. You need to adjust your trade sizes, understanding that, listen, there is this risk and it could potentially hit you in the worst possible scenario. So rather than trying to put all your eggs in one basket, trying to eat it so big with the biggest lot size, understand that if it also goes wrong, it could go too wrong. So news period is not the time to use the biggest of the biggest lot sizes in this world. It's not. You have to adjust your trade size appropriately. It is also important that you regularly review your strategies based on market conditions and performance. This is important. We're going to talk about this on a different topic and a different pedestal on its own when we discuss trading news events. I don't want you guys to miss that day. Trading news events and strategies that you need to put in place to trade news events. You don't want to miss that experience. And like I said, the number one factor that is important in understanding risk events has been covered. Knowing what it is, knowing what causes it. It is key. It is too important. I'm beginning to talk about experiences of people who have experienced, slippages with you just because they did not understand, you know, what it means for a slippage to affect your positions. For those who have seen it firsthand, they know what it is. You must always be prepared. And that's why you must always have an economic calendar with you. An economic calendar with you would always be, the basis of what I'm talking about. Quickly, For example, today we had a series of high impact events. You can see it is called high impact for a reason. Can you see? High impact. High impact. What this means is when this hits the market, it has the potential of causing some adverse conditions in terms of volatility. Look at today alone, we've had monetary policy meetings for the Bank of Japan. We've had retail sales data for the pounds today. And even by 1:30 p.m., we're going to see retail sales report for CAD, the Canadian dollar. It means by 1:30 p.m., you don't expect that the Canadian dollar would just be normal. You could see some increased, in market volatility on the CAD pairs. You must be prepared. So you must have access to, economic calendars that helps you understand when there are high risk events. And for sure, I can tell you for a fact, if you're trading with HFM, which is a reliable broker, you would always get a notification from your HFM application whenever there is about to be a risk event. Everybody on this live can testify. You would always see pop-ups of retail sales is about to retail sales last month was this, and we're scheduling for so time. There would always be updates for you on the HFM application, such that you are always aware when there is a news event in the market. HFM will always do that for you because we need you to understand that these events are not just small events, they are very volatile, and as such, it could affect the market. If you don't have the HFM application, please download it. It informs you of a pending risk event, a news release. When it is even closer, you'll be given a reminder of what it was before. Even when it hits, you'll be told, oh, this has gone up by so, amount of pips. Price has changed by 1%, just to let you know what is happening in the market. If you navigate to Tools and Education on the website and you go to economic calendar, you would also see, HFM economic calendar also showing you the risk events that we have on the day. You can see the red color is also to show you the ones that are very, very significant, the high impact events. For example, I'm even looking at the one for next week, I guess. This is Monday. We have high impact event on Monday. For the euro, you can see for euro Monday, there's a lot of high impact events for the euro on Monday. Also for the pounds on Monday, series of high impact events. We also have for dollar, also on Monday next week. So you could always look ahead to even see, oh, on this day, oh, there's an high impact event for this currency, that currency, and this currency. So I must be careful about this currency from so time, because on this time the news will eat. So it means within the first 15, 20 minutes, within the first 5, 10 minutes, I expect, increased volatility in the market for this particular data. So I should avoid it from so time to so time. That's how you can prepare and plan ahead. You don't want to be reminded of a data when it has already hit the market. You want to know it beforehand. That's what you want to do for yourself. That's what you want to do for yourself. When it comes to navigating risk, planning and preparations must come together. It means you must be aware ahead of time. What does this risk? How does it affect you? How does it affect the market? What are these factors that can cause this risk? When you know those factors, it's not a question of, okay, on what days, at what time, for which currencies are these things going to hit the market, so that I can be prepared ahead of time. Ladies and gentlemen, navigating risk is not by, actually, I put stop loss, I put take profit, not with slippages and gaps. Prices might not be able to execute your orders at the price you requested it. The best thing to do is to be aware of the risk, be prepared for that risk and plan towards it. It is important. It is too important. Once again, saying this, we have a seminar, a webinar already prepared for you guys on how to approach news trading, which is the primary source of market volatility. How do you approach trading during the news? How do you deploy pending orders during the news? How do you even use your market execution during the news? You don't want to miss out. It is important. That will be all that I have for you today in the session. My name is Emmanuel Akiola, market analyst at HFM Nigeria.